Сейчас я бы хотел начать научную сессию, которая должна была быть завтра, но в связи с тем, что Алма все еще в Финляндии, то мы прочитаем эти лекции сегодня, да? И эта сессия посвящена инвестиционному моделированию финансовых рынков. И первый доклад будет доклада Линга Фенга, посвященного связи агентных и стохастических моделей финансовых рынков. I will now switch to English because the talk will be in English. Ling is a PhD student from National University of Singapore and also I think the Boston University, right? From the group of Eugene Stanley, who's the famous econophysicist. So we met Ling on Zurich conference on econophysics and complex systems, and actually he presented quite a bright and intensive model about the financial markets. So I'd like, if you can move in 20 minutes, we just have 5. I'll try my best.
Hi everyone. Thanks for giving me this chance to speak here. So I noticed I'm the first speaker today using English, so in case some of you prefers Russian, you may want to grab a translator. Yeah. Okay, so actually right now, and I just finished a PhD like a month ago, so right now I'm doing like research assistant in Boston University and National University of Singapore at the same time. Right now I'm in Boston. And so this work I'm presenting now is basically, most of it comes from this paper which was published last year. Okay, so before going to the presentation itself, I'd like to discuss some market ecology as well. I'd like to apply it first in financial market. So everyone agrees that in financial market there are typically two types of traders, and one of them called them fundamentalists, who look at fundamental price of the stock or asset, and the other type called chartists. They just look at price patterns or volume patterns and trade based on those patterns. So if we look at this chart, so there are about 500 companies here. Thank you. So these are 500 companies from S&P 500 index. So the vertical axis is the number of outstanding shares held by institutional owners or large institutional owners, or you can call them fundamentalists because they typically hold the stock for a long time, like more than a year or two. So you can see that most of the outstanding stocks, in terms of percentage, they are in the hands of fundamentalists, and if you average it out, it's about 83%. Which means, if you look at the stock being held by people, it's like majority of the stocks are held by fundamentalists, and only a minority is held by chartists. But that's not a full picture. If we look at market ecology in another picture, so we can see that in terms of trading volumes, the number of stocks being traded, the chartists are trading about 80% of the stock. And the fundamentalists, although they are holding majority of the stocks, they trade much less frequently, so they only contribute to about 20% of the total trading volume. So the conclusion here is, if we were to look at the daily price fluctuations, if you want to understand the day-to-day market dynamics, probably chartists are a better benchmark, or their behavior is more important than what the fundamentalists are doing. Okay, so most of the work are based on the assumption that chartists are the players in the market, and fundamentalists are playing a less significant role. And, okay, before going to the first market behavior I will talk about, let's play a little game here, and let's make it fast. So I have something in mind, anything. I'd like all of you to guess. So first, I give you no hint. Whatever, no one cares, right? What if I say, just imagine, the one who gets it right will get $1 million. I'm sure everyone will participate. And what will happen? Everyone will give you all kinds of answers because there's no hint. What if I give you a little more hint? Can anyone make an intelligent guess? Let's make it fast. $1 million. Okay, so it could be a ball, a sun, the sun, or anything round. Anything round, I mean my mind. If I give you more hints, what is this? Could be a bone, a fruit, a pendulum, right? If I give you clearer hint, oh, everyone knows it's apple. But it's really fruit apple I'm talking about. I may well be talking about the brand name. So you can see as I give you more and more and better hints, there are less and less, there tend to be less and less opinions among the audience. So what's the point I'm making? Actually, financial market, if you look at the behaviors of chartists, they also make a guessing game. And they also take in signals. What are signals they're taking is the stock price patterns they're looking at. Those are the signals. So imagine if the past stock price has been flat, or there's been a slowly increasing trend with a lot of noise, or there's been steady increasing trend, or something like this. And here everyone knows there has been a bubble and it's bursted. So I'm sure there's only one opinion right now, everyone knows there has been a bubble. So this is similar to the game I talked about just now. The guessing game, apple guessing game. And the point I'm trying to make here is if the signal people get getting clearer, imagine there are a large number of people, there will be converged opinions, there will be less opinions among the people. So this is basically the first assumption in the model I've been talking about. So of course there are other ways to argue this point. Let's say you can argue from the point of adaptive strategies because people are changing their strategies using the most profitable strategies. And you can also look at it in terms of like from the Olympic saying there will be so many ways to skin a cat. Although there are many chartist strategies, maybe they don't differ by that much. Yeah, these are traditional strategies. These are modern strategies. I mean, the strategy evolves, but the way the people use them doesn't change that much. I mean, so at any time period, you can see that if there's one strategy, given the price pattern, if there's one strategy that's most profitable, then everyone will flock to it. Everyone can use the same profitable strategy until it is no longer profitable, because stock market is a zero-sum game. So, yeah. So another argument I'm trying to make here to tell you why there is convergent opinions in market and sometimes there's not, because although people may be using the same strategy that has been proven to be most profitable during that period of time, but they may well be using it in different ways. Or I mean, there might be different parameterizations, because this quote I got from a book written by a market practitioner, a banker actually. So technical traders, they go in the market at different times, and they also hold in different ways, they have unique holding periods, and of course they have different risk appetites. So even though they might be using, even though if they're using similar strategies, the different parameters will tend to give you different indications as to you need to buy, sell, or just hold. But under extreme price fluctuations, these different parameterizations will be wiped out. The difference in parameterizations will be wiped out. So the strategies will give you the same indication on your decision. So what I want to say is when there's a small signal, there's diverse opinions, and when there's a strong signal in terms of the price change, there's convergent opinions. course, there are also empirical evidence on market behaviors, and to show that this is really true that sometimes people converge their opinions in stock market due to time contrast here. So then, this is the first step of our behavioral model, or you can call it agent-based model. It's rather straightforward. It means everyone has a size of 1 every time that you make a decision to sell, hold, or buy with the probability P. Because we fix the trading decision made on a daily basis, so we can empirically estimate this value of P, which, if you're interested, you can read the paper. And the step 2 is just to calculate the total demand, aggregate demand for stock, so and calculate the return corresponding. And the third step is basically a mathematical formulation about the opinion convergence. So the simulation result of the model is quite good. So the graph on the left basically to show you the cumulative distribution for absolute returns. And so the red curve is from SP500, the blue curve is our simulation result. So you can see the tail behavior can be captured rather well. But most agent-based models do capture the return distributions under certain parameters. What our model can do in addition to that is we could also capture the total number of trade distribution as well. And yeah, so NT is the total number of trade, daily trades, and we also can find that the tail is roughly in line with empirical observations. Okay, that's basically about the behavioral model. And in order to make it to be useful, we need to make a mathematical model out of it. But before going to the mathematical model, let's look at another empirical fact, and it's called heterogeneous investment horizons. So we know that different people hold the stock for different durations. Some people are daily traders, some people are intraday traders. And there are also fundamentalists who hold the stock for more than a year, 2, or even 5 years. So we also, it's likely that we have this empirical survey result, and it was published 3 years ago. So it basically tells you, for different holding periods or forecasting horizons, what kind of strategies the fund managers use. So this graph is surveyed based on the US fund managers. I think there are a few hundred of them. So the questionnaire is constructed in the way that they ask you 3 types of strategies based on flows, technical analysis, and fundamentals. Flows is like buy and sell, how much is bought and sold. So it's kind of technical analysis because you don't look at fundamentals. So if you combine these two, we can see that in the intraday level, the fund managers don't really make much decisions. Of course, this survey is done before year 2008. It was published in 2010. So in that time, intraday trading was, high frequency trading wasn't so much. So there wasn't so much intraday decision makings. But if you look at days and weeks, most fund managers rely on technical analysis rather than fundamental analysis. It's only up to like more than 6 months people look at fundamentals, which means for people who are using technical analysis, they have different investment horizons. Some people have days, weeks, some people are using years. Although, yeah. And we can also see how these heterogeneous investment horizons impact the trading activities. So the technical strategies, you can also see because they have different investment horizons, so the different investment horizons affects trading activity in such a way that increasing trading activity induced by volatile market induce more trades. And they could be because of placement of mini orders, margin calls, trading thresholds, or any other factors. Alright, so now we have 2 assumptions, and we can make a stochastic model out of it. So what are the 2 assumptions? The first one, or the second one, is the heterogeneous investment horizons. Some people look further, some people look nearer. And the second one is opinion convergence under signals, different signals. So if you put these 2 ingredients into a stochastic model, and we construct it in a similar way to the arch formulation, you can get this simple formula. And sigma t plus 1 is the conditional variance of returns at time t plus 1. I explain what the meanings of the other variables in short while. So of course, return is calculated based on the conditional variance and the standard variable, random variable of zero mean and variance, like all the arch type models. Okay, so let's examine the stochastic model in detail. So sigma t plus 1 is conditional variance, and t plus 1 conditional variance of returns. And A, if you look at the derivation of the model, the interpretation is about average, the size of average volatility, and it's not very important here. And the size of B characterizes relative proportion of trades done by chartists. And this big sigma t is expressed in this way. St is the price at time t, and so it's a sum of the absolute price difference between the past I periods weighted by I to the power of negative d. And this d is not we arbitrarily define it, but rather we retrieve this value d from this chart. So you can see that all these parameters you can roughly obtain it from market without doing any statistical estimation from price returns. And so after this parameterization, we can do our simulation. And this graph shows you the autocorrelation of our simulation result and SP500 result. So the two at the top are the result for absolute returns autocorrelations. You can see two are rather similar. And the bottom two autocorrelation result for square returns. You can see they decay faster than absolute returns. And the scale is comparable. If you just look at the returns, absolute return distribution, you can see the simulation can capture the empirical result up to about 3 or 5 sigma, which is, I think, is really good. So the model captures two very important properties. One is long-term memory of returns, of volatility of returns, and the other is factor. Of course, this slide is more like for the interest of physicists, because our stochastic model, from our stochastic model, we can analytically show that there is a steady relation between the autocorrelation exponents. You can see that these two autocorrelation graphs, they decay very slowly. If you assume that decay is a power law of a function, you can derive that the power law decay exponent, they are related to D, which is the decay of heterogeneous investment horizon. They are related quantitatively by this grading relation. But this is what is predicted by our model. Whether it's true or not, let's verify it. So if we verify this relation on the set of Dow Jones, 30 Dow Jones Industrial Average Index components, so there are basically about 30 points here, each of them represents one stock from the Dow Jones Index components. If the point lies within these two lines, it means our scaling relation is fulfilled. So you can see, except for 3 stocks, which lies on the borderline, all the others fulfill our prediction. And further study can be demonstrated that our model can be related to Figage, H-arch, Figage in a very loose sense, but they are very different. And a final remark about physics and finance is that people have found that the financial market, why we call ourselves econophysicists? Because we found some interesting things in finance that's very similar to physics. So one of it is that we thought the financial market of returns behaves in a way that is similar to phase transitions in physics, which means the financial market exhibits some critical behavior. And there are many reasons to argue why there is a critical behavior in the financial market. And our model gives a very explicit and quantitative account to this phenomenon. So in physics, it's called Ising model, and which means if you magnify this graph, magnify further, they all look similar on the critical conditions. This is physics. For financial market, if you look at 1-day return and you magnify it to 4-day return, you magnify 6-day return, they also look similar. This graph doesn't show that similar, but later I'll plot another graph showing how similar it is. So eventually there is a one-to-one correspondence between physics, Ising model, and financial market. If you transform the spins, which is the magnetism of each particle here, into the volatility, absolute reason R, and if you change the coordinate system from position to time, and the dimension, the physical dimension here is 2-dimension, and here actually the dimension is the decay speed of D, of heterogeneous investment horizon, and there's a correlation between the spins, and there's a correlation of volatilities. They also follow a similar functional form. Then you'll see there's nice one-to-one correspondence. And why I say there's a scaling relation in there's a scaling variance in financial markets, because if you look at daily 4-day, 16-day, 64-day returns, if you scale them, they all collapse onto one single curve very nicely. I mean, this line is a Gaussian curve, just for comparison. So this is the empirical result, and this is our simulation result. So yeah. Okay, now we come to summary. So what have we achieved here? We gave a possible explanation or the possible origin for fair-tail distribution in financial returns, which is possible due to the Peony convergence, as we have demonstrated in the first part. And the long memory in volatility could be possible due to the heterogeneous investment horizons. Not only we demonstrated qualitatively, we gave a very quantitative account of this phenomenon. And of course, we also, this model could also give a behavioral meaning to the general class of stochastic modeling. And that's my personal opinion. And also, our model, you can retrieve the parameters from empirical behaviors rather than statistical feeling. And yeah, there's also a possible origin, suggests possible origin for criticality phenomenon in finance. And that concludes my talk.
Thank you very much, Ling. And if you have any questions.
You quite briefly covered your agent-based model, so I didn't actually get where do you put fundamental traders and where do you put chartists, and why do you start the talk with these two classes?
So actually, the agent-based model doesn't cover fundamentalists at all. You can see the nodes. It's kind of the opposite what economists are doing, but our rationale here is the market trading volume is dominated by chartists, and the fundamentalists, they react to news, and news comes randomly, so they can treat the news as news.
Okay, sure, пожалуйста. Один вопрос сейчас есть. I've got a question actually. In your model, the strategy of the agents, do they evolve?
Yeah.
Do they learn? The agents.
That's one of our assumptions, but you get rid of that. Is we didn't really pay attention to the details of the evolution.
So it's mostly like zero intelligence sort of behavior.
Right. If you have a behavior, it's not zero. There's something close to that.
Okay.
Actually, I'm working on the evolutionary behaviors and see how to realize how close the real behaviors can get. Maybe they get this different. It's part of my coverage.
Okay, thank you very much, and let's thank Ling.